more hikes get priced in as the Fed says nothing is off the table. Stocks rebound from oversold levels, but the macro picture is turning more gloomy. All this and more in this week's Macro Insight. Okay, welcome back to Macro Insight, everyone. Today is the 1st of February, and let's take a look at these markets. So, really choppy week last week, but the market, well, the equity market at least, managed to finish on a positive tone. Obviously, the much anticipated Fed meeting delivered a hawkish message that nothing was off the table in terms of aggressive hikes if deemed necessary to get inflation down. So, before the press conference, the market had continued to rally, but it was only until, Powell was kind of questioned more directly about whether they could hike at every meeting this year, and he didn't rule it out. That's when the market had the kind of realization that they're going to kind of do what it takes to get inflation under control. They're certainly talking a tough game. Okay. The US rates curve kind of took that as an excuse to stick an extra hike in the front end yields. And if we have a look, you can see 2-year yields did again what they have been kind of doing. US 2-year did 3.5 standard deviation move. So a pretty aggressive move, order of magnitude around 20 basis points in that 2-year part of the curve. Now the other stuff in terms of big movers, obviously you had Euro take a hit on that as the dollar rallied. Because of that kind of hawkishness out of the meeting. You also had, yield curves continue flattening as they have been doing every time we get a hawkish news out of the central banks. But then outside of that, nothing too crazy going on. You had, Apple and Microsoft kind of rallying post earnings. And then on the downside, a bit of currency moves going on. Basically, gold obviously turning around, copper turning around as well. But really, the real big outside move there was the US 2-year. Okay, so yields, and it wasn't just the 2-year yields kind of across the curve moving up. So you can see here on this chart, we bring in this is basically what's been happening. 2 yields. So obviously after the press conference, that kind of really was the thing that accelerated it. Now looking at stocks, the fact that equities managed to find a low on Friday and staged kind of a nice 2-day rally was most likely due to the fact that we were very oversold, okay? More than any real sense that the fundamental backdrop is improving. The fact that, the most beaten up sectors yesterday, for example, like ARK were leading the way, right? You had ARK, I've got coin as a proxy for crypto stocks. We've got MSOS, the cannabis stuff. All of that was really charging ahead of the S&P yesterday, right? So that smells much more like a bit of a short squeeze, reflexive bounce from oversold conditions than anything meaningful just yet. That's not to say it can't turn into something meaningful, but off 1 or 2 days of price action, when these are the names that are really bouncing the most, doesn't really, I think it's a bit early to say. Now, the vol market, as it often does, gave a few signs of downside exhaustion. Okay, so the kind of main things to notice from what the vol market was doing, you had obviously VIX spiking, but this kind of bull bear indicator spiking alongside the VIX often signals a bit of a overextended panic to the downside. You had the put call ratio spiking, everyone piling into puts, even retail, right? Put volume spiked and even retail was buying large amounts of puts. Statistics showing like the 5-day average notional reaching $1 trillion for puts. And then for me, this kind of divergence between, and this bottom chart here, I've got the NASDAQ and I've got the Vixen, which is obviously the VIX of the NASDAQ. And you saw on that Monday low initially, that where it reached its highest level of around 43. But as we went to pretty much retest or get significant within a whisker of those lows on Friday, there was quite a shortfall on the vol, right? The vol was capped at around 38 on the Vixen. So that's what we call a volatility divergence, right? And we often see those volatility divergences when markets kind of retest their local lows and vols have already had their spike and they don't get anywhere near that level. That often shows you a bit of a sign of exhaustion to the sell-off. And then we went on to, obviously, NASDAQ has rallied pretty strongly off the back of that. Right. Now, whilst the sort of re-emergence of buybacks post earnings, now that they're coming out of the blackout, and what looks like more cleaner positioning that may extend this kind of rally for, a while, it's hard. It's going to be hard for it to, just kind of smash out straight back to the highs, I think, with the fundamental backdrop deteriorating so much. Yeah. So this kind of CTA tracker shows you that a lot of CTAs positioning has come down. So CTAs are like the momentum followers, right? The systematic funds that just kind of use systematic momentum signals to kind of trade the market. So they've kind of their positioning has been taken down pretty significantly in this latest sell-off. But like I said, buybacks are back. And if buybacks become the marginal buyer of the market, then you could see some support in the market in the short term. Now, looking at the macro, obviously, the best guy out there on macro, hands down, is Darius, and he's put some really good charts out this weekend on his stuff. So I'll just put a collection of those together. So obviously, he's been calling for, deflation. His models are basically forecasting that both inflation and growth are going to slow down. And this is basically, this kind of regime forecast is on this chart on the top left. And it's saying that, right now we're at January, February, we're in the inflation pocket here, where, growth is slowing, but inflation has been high. And that inflation is going to roll over and going to take us into this quadrant down here where both growth and inflation are slowing. And that's the forecast. And the idea being that risk assets are going to struggle when that happens. On the top right, you've got this kind of forward, again, it's a bit of a forecast on growth. The blue line is kind of his leading indicators for what growth is going to do. And then he kind of shows how that kind of helps predict or track what high beta versus low beta do and what Bitcoin versus treasuries do, basically. But the idea being that this kind of blue line is our composite of leading indicators for growth. And as that's peaking and rolling over, it is likely to take high beta assets with it, right? So crypto, the bear market that's starting in crypto may not be over for quite some time. Yeah, that's not to say we don't get a bounce, over the next couple of months, maybe if general risk assets can bounce, but some turbulent times ahead for crypto most likely, and high beta assets in general. Okay, and that's why he in his portfolio allocations has been de-risking, or saying that he's going to de-risk and pivot to a more defensive stance in any kind of bounce we get over the next couple of months. Right now, this bottom left chart is talking about the risk of the Fed triggering a stock market crash. Now, the interesting thing here is, the blue line represents real earnings yields. Okay, so it's basically saying earnings versus inflation. And the chart basically shows whenever this blue line goes below zero, so you have like a negative real earnings, that's usually a precursor to a bit of a sell-off in markets, right? And these red bits down here show you the depth of those drawdowns, right? So you've got 40% drawdown, 20% drawdown, 40%, 50%. So some pretty deep drawdowns in the S&P on the back of real earnings turning negative. Okay. Now, if you look at previous episodes of real earnings turning negative, the interest rates, the Fed funds target rate, which is the black line, there has been room to cut that rate to then support the market when it sells off. Okay. So where you've had periods where real earnings have turned negative, that's led to a sell-off in stocks, but then the black line has come down as the Fed responds and cuts rates. Right now, the problem is we now have got the most negative earnings yield we've ever had, plus, so that's saying a sell-off's coming, a major sell-off's coming, but the Fed funds rate is on rock bottom and is only going up, supposedly. Okay, so that's a pretty precarious setup, right, compared to previous what we've seen. There's been that cushion, there's been that room to cut rates in the face of what happens to the market. So it'll be interesting to see how deep, if we do get a big correction this year, how deep it can really go, given that they can't do a lot to stop it. unless they do a complete U-turn. And then, I mean, I don't know what the hell that does to inflation, right? So I thought that was a very, very interesting chart. And then the last one on the bottom right just talks about goods consumption versus trend versus services consumption, right? So everyone's saying, you know, we're going to get some sort of growth rebound on the back of services going back towards trend because the world's going to reopen post Omicron, right? But remember, we brought forward a loads of goods consumption while we were all locked in our houses for 2 years, right? And if that was to come back towards trend as well or faster, then that will be a net shortfall, right, in demand. So it's not clear that you're going to get that reopening impulse or it's going to last for very long, and it's not going to be counteracted on the other side by goods consumption and goods demand falling off, basically, because you've already brought forward all that demand. You've got no more goods to buy, right? All those purchases that you made whilst you couldn't do much else other than buy stuff with the money that you got sent by the government, you're not just going to keep buying that stuff, right? Yes, we're oversold. Yes, buybacks are coming back and earnings maybe aren't a disaster, but the fundamental backdrop is really looking worse and worse, okay? So that's kind of what we're saying there. Now, what have I been doing? I've actually been accumulating call options, right? As subscribers will know, I've been using the sell-off and risk to tactically position for a bounce into March. Whether we get it by February, I don't think we're going to get it by February expiry in any meaningful way. So I'm thinking by March, we could have a reasonable bounce, maybe back towards 4,800. That's kind of what I'm thinking. So I've been buying call structures, whether it's call spreads, call ratios, call flies. Been buying call structures on the S&P on the way down. I also picked up some KRE, which is the regional banks index. What kind of made me look at that regional banks index was just that obviously the value sectors seem to be, you know, performing a bit better. And whilst energy has been absolutely flying, right? So if we bring up the chart on energy here, I mean, that's really been roofing it in the face of the rest of the market going down. Financials like XLF have had a bit of a pullback down to these kind of range lows, and KRE also same sort of story, right? It's got a bit of an uptrend here. It's kind of approached back towards the lower end of that uptrend. And I think, you know, if you just look at the kind of move it had 20th of December to 14th of Jan on an upswing, general upswing in kind of value / cyclicals, with yields staying quite high. I don't think yields are just going to crumble in the next 1 to 2 months. With yields staying quite high, that's generally good for banks. And I think that these regional banks could do well, basically, right? So I've been buying the 75 strike calls on these, picked some up on Friday. And I think it's one of those things, this thing could get to somewhere between 80 and 85 by March in that scenario. And that's kind of what I'm playing for right now. The oil continues to trade super strong. Okay, we've been saying, you know, how what a good long oil has been, and how its kind of correlation to risk assets just hasn't been there. Now, there's been a number of factors, but so these are charts that kind of I found interesting on oil this week. You know, we mentioned that the futures time spreads have been going into backwardation, signaling concerns of a shortage of inventory at Cushing. So that's the kind of bottom right chart. There you see that yellow line spiking up again. That's the front two contracts going into steeper backwardation. So that dynamic has continued, right? Which is kind of keeping a bid in that market. Okay. The inventory data, we saw, you know, big drawdowns in inventory, and now inventories are running very, very low relative to kind of historic averages. That's these charts here. And then Goldman's has been banging the drum on the structural supply demand imbalance, right? So they've got their charts out. This is the chart on the left, showing that, you know, how low inventories are basically, right? So to return to inventory levels, you know, they need to build 300 million barrels per day more over the next 2 years. And that's going to require sharply higher prices, apparently, according to Goldman's, right? So that this is kind of based on data and forecasts that they have, right? So they're calling for, obviously, we know they're calling for over $100 a barrel at some point later this year. Now, so all these things look very bullish for oil. The fundamental backdrop looks good for oil prices. The only thing to be careful for this week is the OPEC meeting. We're going to see if they get anything around production increases, or they just stick with what's planned. It seems unlikely that they're going to go too aggressive on production increases, seeing as they've been struggling to meet their quotas anyway in a lot of places. They've also been downplaying the recent rise in oil prices, suggesting that it's been more driven by geopolitics than stronger than expected demand, right? So I don't expect them to tank the oil market, but just be aware, if you've been long, maybe take a few chips off the table in oil to be able to rebuy on any dip. But I would certainly keep some exposure because the trend is strong right now in oil. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.